right, so these guys are very well-known investors here in the DC area, and I apologize to them ahead of time because I have grossly oversimplified who they are and what they do. But for simplicity's sake, we have down on the right Neil Wilson, and I'm going to let them introduce themselves. But Neil Wilson down on the right, private equity. We have Alan Dew in the middle, venture capital, and we have Randy DeMalki right here on my right, angel investing. And so why don't I have you guys one by one just introduce yourselves, what you do at the firm, where have you been before, and just kind of a little bit about, differentiating between private equity, venture capital, and angel investing. Go ahead, Neil.
So I'm Neil Wilson. I am one of the founders, and I'm the chief operating officer of EJF Capital. We do a fair amount of private equity, of about $1 billion in private equity, but we have another $5.5 billion in hedge. So we really operate in the confluence between the two areas. So we do a lot of later stage type, investing, and we put together companies that are they're on third base and on their way home if everything works out okay. In terms of my background, I'm a lawyer by training, so it's never too late to get into business and throw away your old degrees. So I was a practicing securities attorney here in D.C. I came to D.C. because it's the legal capital of the world, arguably, and I was a securities attorney, including 4 years at the SEC. And I went in-house with a client and worked on the IPO, and that was Friedman Billings Ramsey, and that was back in 1997. Went in-house 2000, moved to the business side, and for 5 years ran their alternatives group, which included hedge and private equity. And we actually had some VC. That was a mistake on our part. And we went on our own in 2005, my partner and I, with 12 people. We now have 70 people, and we manage $6.5 billion total.
Hey guys, my name is Alan Dew. I work with Revolution Growth. So Tom, I don't know about the well-known part.
And just a little-known fact, I'm really happy that Alan is here. The only guy, let's see, no, Neil doesn't really have that much gray hair, but Alan doesn't even have an MBA yet, right? So he is investing with Steve Case and Ted Leonsis and a lot of these guys. Revolution is a very well-known group started by Steve Case, but you can get all this experience without an MBA, but I think that's potentially a next step for you, right?
Yeah, I'm actually in the middle of applying. Yeah, so
29 years old.
So fingers crossed. Anyhow, so to give you a little bit quick.
I'm also 29, just for the record.
I think it's the tie. So to give you some quick background on Revolution. So Revolution, as Tom mentioned, was started by Steve Case, who was the former founder and chairman of AOL, and also a second partner, Ted Leonsis. If you guys follow basketball, hockey, he's the owner of the Capitals and the Wizards. So to be able to work these two guys is actually pretty cool. Anyway, so Revolution has actually two branches. One is the Revolution Venture. They do a lot more Series A, Series B, kind of $10 million check sizes. And Revolution Growth, on the other side, we do more kind of post-Series C to pre-IPO rounds. Generally, size of the checks ranges from anywhere between $30 million to upward of $75 million. And the sectors that we focus on, both on the venture side and the growth side, are generally tech-enabled consumers. So some of you probably have eaten at Sweetgreen before. We're actually one of the largest shareholders in Sweetgreen. If you have ordered T-shirts for any sort of school events or whatnot, we're also one of the largest owners in Custom Ink. So just give you some familiar names. And my background, so prior to joining Revolution, I spent 3 years doing technology investment banking out in San Francisco, working with a firm called Thomas Weisel, which was later acquired by Stifel Nicolaus. And before that, I was an undergrad at Berkeley, so go Bears. Any of you California guys out there? So yeah, that's about it.
Great, thanks, Tom. This is going to be a lot of fun. Is this on? I'm Randy DeMalki, and as Tom said, I've been an angel investor for 15 years here in the D.C. area. Before that, I spent 12 years in the telecom industry, so that's the one industry I'm actually a qualified expert. Everything else, I'm a complete generalist, which is good. So as an angel investor, what that means is when I was in the telecom industry, I was fortunate enough to make a little bit of money, decided that I didn't want to work in that industry, decided to be an investor on a full-time basis. And so I'm spending all day, every day, looking for deals, consummating deals, and trying to mentor the executives of those deals so that we can get an exit and monetization, hopefully. I run 2 angel networks, which means groups of angel investors. One's called Liquid Capital Group. The other is called the Private Access Network. Liquid Capital Group has dedicated funds, just like Revolution and Friedman. In the Private Access Network, people opt in on a deal-by-deal basis to the individual companies that we invest in. So 2 different models there. Some are good for people who want to be more involved on the opt-in model, and if you want to be a passive investor but get diversity from the public equity markets, then you can become a committed investor in the liquid capital arena. So we've invested in about 20 companies. We also invest in other funds, both venture and private equity, and we've done about 20 of those. And the idea is, again, if you want to play in the technology world at the early stage, this is a great way to do it, and it's been a lot of fun.
So as we pointed out, a lot of undergraduates here. A lot of these folks are thinking about, do I want to be like you guys someday? Can you give them any thoughts on, what type of person or background or mindset you sort of need to have to do what you do? Neil?
Sure. So I think when I was a young lawyer at a big law firm, slaving away, putting a lot of hours, a partner did me the biggest favor. He came by and he said, you got to get out of the office. You have to really create networks, and you have to do it any which. Don't waste your time, but make sure you get out X number of hours a week. And I think that was the best advice as a young person and young professional. You be wise about it, but you want to network because the people who are in this room, there's going to be huge successes in this room, in the business world and in life. And if you know them or you have two steps away from them, then that can be helpful to you. And it also makes it more fun. I mean, you can hear in Randy and Alan, they're bragging about the companies we invest in. You've never heard of. They're financial institutions that do like mortgage servicing. So it's kind of boring. But the fun part is working with people and really having a group that's proven itself come in, and then we say, all right, here's $100 million because we've vetted you for 6 months and we've got to know you. The other thing I'd say, I've got 6 kids myself, college-age kids, one out of college. We do unbelievable background checks on people, and I know that sounds like heavy, but it's true. Because you can't take, if you're putting out $100 million for institutional investors, you can't take dumb chances. I mean, there's plenty of smart people out there with great ideas. So I would say, be thoughtful about how you conduct yourself all the time, and that's unfortunately the dad in me talking. But my advice would be, though, in terms of how you study, be very disciplined. Have a plan. Whether you're a late person or an early person, do a lot of reading. Do wise reading. Don't waste your time with a sports page unless that's the area of interest. If you love to go into that area, do it. But become an expert in something. In this world, you have to be an expert. And if you're not an expert, you can be a generalist to a degree. But Randy is saying he knows one area so well, so he knows where all the traps and all the problems are, and that does translate into other areas. So you have to be an expert in at least one area and really know it well. Mine happened to be securities law, which transferred well into investing because when we structure things, we know where all the traps are, or at least we think we do. We can at least try to solve for them, and we can make sure that we've protected the downside, which is really the key to at least our area. Less so with venture and angel, but if you're in PE, it's the downside risk really has to be protected.
Yeah, I echo Neil's 2 points on one being relentless about networking. Just be shameless. Go out, talk to as many people as you can. You'll be surprised what you can learn from these people. And 2, on a day-to-day basis, a lot of my job involves cold calling on companies. Kind of like I compare myself to a used car salesperson. I just don't wear a suit. And you have to call on companies who don't necessarily want to talk to you, right? That's where you have to be absolutely relentless and shameless to reach out and sell your own firm, right? This is where that interpersonal skill comes in, and you have to be able to build a rapport with people within that first 5 minutes. And I think second point is become an expert in something. So I think that's absolutely right, because within VC, when people often say there are only 10 people that are making money in VC, it may be a little bit exaggerated, but I think it's true to the extent that most startups will fail, right? So if you're the vertical expert in SaaS or infrastructure or data storage, whatever it is, I think that helps you reduce the chance of making dumb investment decisions. And I would add a third point to that is you have to be able to operate under uncertainty. Contrary to what you would do in PE, which is a lot of financial engineering, you have very mature companies that have long operating histories. You can look at the EBITDA numbers, you can look at the net income numbers, you can slap a multiple on top and kind of calculate what your IRR would be, right? But in VC, a lot of these companies that we invest in don't have EBITDA. A lot of them don't have revenues, right? So you have to be able to come up with creative ways to value a company. A good friend of mine started a company, some of you engineers out there might know, called Docker. It's a virtualization company. The company last raised, I think, $70 million on a $1.5 billion or $1.7 billion valuation. And the company to date makes this much revenue. So as a VC, how do you value it? How do you value that, right? So you have to be an expert in that particular space to be able to understand the underlying value of that asset.
Sure. So for anyone thinking about being an angel investor or a venture capitalist, big difference between being an emerging company CEO and being an investor. And you might lump them all together and say, well, it's emerging technology, but it's not. The CEO of an emerging company is essentially doing one thing. I mean, they'll do many things during the day, but they're very, very focused on one business, and it might take 8 or 10 years to bring that business to the goal line. Someone who's an investor is looking at a different business every single day, and in some cases every hour of every day. I may see 3 or 4 companies in a day. So you have to ask yourself what your personality is like. Do you want to focus on one thing for 10 years? If you're going to be here for 4, that's a good start. I didn't enjoy school. 4 years was way too long to be focused on anything. So if you look at the kind of people that are venture capitalists, and this is kind of a broad generalization, but they tend to have, an ADHD type of personality, which is very positive things because it means you can jump from topic to topic very quickly in a serial fashion and not get tired from it. You ask an ADHD person to, think about 100 things, they can do it. You ask someone who's good at focusing for long periods of time to think about 100 things, and it tires them out. So you're going to have a natural affinity for venture and investing if your personality allows you to jump around from topic to topic very quickly and shift focus. The other thing is you find a lot of athletes in venture, and specifically you find triathletes in venture. We tend to be competitive, tend to enjoy kind of a rush. We're okay with ups and downs. So again, the kind of slow and steady person might say, oh, this is all over the place. This is crazy. I don't understand. You were running 100 miles an hour, and now you're over here resting. I prefer slow and steady. And some firms might be slow and steady. I'm just saying across the board, you're doing multiple things. You should be somewhat good at the multiple things. Again, in triathlon, people have their specializations, but you got to be good at 4 separate things: swimming, biking, running, and transitioning from one to the other. And, again, some people are going to look at that and say, I don't want to do anything like that. But the people who say, oh, 4 sports, yeah, why not 5 or 6? They're probably going to do better in venture and investing because of that ability to not necessarily master, but be pretty good at multiple things.
So let's switch to the industry and kind of where we are today in 2015. So I was CEO of 2 companies, and that's how I got to know Randy. Pitched Randy as an angel investor. Never gave me money. I'm still annoyed at that. But
Sorry.
Those were the go-go internet days. There was a networking event every single night. Then there was a big bust, obviously. But I don't know. There's been a lot of green on the on a lot of, they say in golf, right? There's a lot of green between the hole and the ball and the hole. There's been a lot of green since I was doing that, and a lot of things have changed. A lot of phases, a lot of ups and downs, et cetera. How would you categorize that? I don't want to go too far back because we have a young audience here, but say in the last 10 years, what phases have you seen, and what phase would you say we're in now? And kind of coupled with that, Alan, you were mentioning some of the types of companies you guys invest in. If these folks are thinking about sort of maybe what industry to go in, hot industries have come and gone in the last 10 years, but what are some of the shiny pennies these days that hopefully are not just flashes in the pan? So what phase, so to speak, are we in now, and what industries should these guys potentially be looking at? Neil?
Well, I think we hold ourselves out as experts in the financial industry, so that's really the main focus of our firm. Now, that has a lot of permutations, but the best thing that happened to our firm was 2008. That was terrible for the country, but it was great for our business because it was disruptive. I mean, it completely upended the financial services community and put it frankly, in doubt, right? So where we've made money, and I think this is the key to running an asset management business, is we recognized in the throes of disaster that there was going to be a lot of what we would call volatility. There was going to be a lot of action and a lot of opportunity. So we calmly put together distressed funds that basically we took bets on certain areas we thought would survive, like monoline insurers, right? So what are they? MBIA, they insure all municipal bonds. What does that mean? That means they can't let them go under, even if they're bankrupt. The states need to issue municipal bonds, otherwise the world comes to an end, or the United States comes to an end. So we took bets like that, and in certain structured product. And then as the government got involved, then our vol became regulatory, right? What does this mean when they passed the Volcker Rule, or they're talking about the Volcker Rule? It's even better. They took them 4 years to get Dodd-Frank passed. The Volcker Rule is another 2 years. That gave you just different types of volatility, so you could make bets based upon where do you think the regulation is going to lead you. Now, albeit the market recently, we're more constructive, right? We're now at the part of the business cycle and financials where, if Yellen would just please raise interest rates, it's like the best place to be because the Darwinian forces have already wiped out the small minnows and the canoes and the boats that aren't going to make it, right? Those who have made it in insurance and in banks. So for us, it's a constructive period. So then we ramp up our private equity, more illiquid investing, putting together companies with management teams that exploit an opportunity. So a couple examples. So big banks are becoming utilities. They're becoming Pepco. They're becoming Con Edison because the regulators are making them. So they can't lend anymore. So who's going to jump in? The unregulated private equity business, right? That's what we do. We do a lot of lending, and we, so for example, mortgage servicing. Banks had to get out of it. They're not servicing mortgage because they're deemed risky because we're fighting the last war. So we just look for opportunities that the market gives you. And going back to what I'm saying about the best thing about, or the key to asset management is we're nimble, right? We don't try to say everyone should be using an app for X. We just say the world is the way it's going to be, and we have to react to it. And I think that nimbleness and trying to recognize and not trying to impose your own view is the key. And then knowing what you don't know. I mean, there's certain areas that we don't trot into, we'd like to, but we just know it's not smart. So one example, and I'll stop, is in small, person-to-person lending. There's something called the Consumer Finance Protection Bureau that was set up in Dodd-Frank. Why do we want to take the risk of doing payday lending or anything that someone could look at later and say, boy, why did you lend to a guy who's got his paycheck from the factory, right? So you have to, even though that would be a great area to lend into, you stay away. So that knowing what you shouldn't do is I would say, and you guys would probably agree, is almost more important than knowing what to do at any given time when you have capital. So.
I've only been working long enough to see one cycle, so which was the 2007, 2008, mortgage crisis, so I won't comment on the cyclicalities of the market. But one thing I think I read this somewhere the other day is good markets come and go, but good companies don't. So, and this is where I go back to the point of being an expertise in certain verticals and stick to what you're really good at, what you really know well. One example is, a couple of years ago, SaaS was all the rage, right? SaaS company was getting valued at 10 times forward multiple. I mean, crazy stuff. Now SaaS valuations have come way down. You're buying companies at 4 times, maybe even 2 times. So, good markets will come and go, and a certain sector will get really, really hot for a short period of time. And so now I think food sector is starting to heat up a little bit, and vertical e-commerce was pretty hot 2 years ago. So my suggestion is, and I tell myself this every day, don't chase the hype. Do not chase that, because that's what dumb money does, right? You bid up the valuation, you bid yourself out of any chance of making money. So stick to what you really, really, know really well. And one example is out of our portfolio companies, Sweetgreen. It's kind of traditional brick and mortar. We call it tech enabled, so there's a huge tech component to it when it comes to payment and order prediction and things like that. But still, at the end of the day, it's a restaurant business. But guess what? It's one of our best performing portfolio companies.
So just a point of clarification, and you might not get this for years, but when Alan's talking about multiples, he's talking about multiples of revenue, and when Neil's talking about multiples, he's talking about multiples of EBITDA.
That's correct.
Okay, so again, you'll get that in 5 years when you're
Our
back for your
companies don't have
MBA.
EBITDA.
That's right.
Yeah, we're looking for profit.
That's right. There's
Now.
no profit here. EBITDA is earnings before interest, taxes, depreciation, and amortization. And venture-backed companies essentially have no earnings, because the idea is we want to burn as much money as possible to build a beachhead in a particular market where our competitors are trying to do the same thing. And then we're going to sell that company to a big, stodgy, slow growth company that has thousands of salespeople around the world, and they're going to use their economies of scale with vendors to bring down our costs, and then they're going to make money. And our job is not really to make money with small, emerging, hyper-growth companies. In terms of industries I think you should be looking at, I'll mention 2. First of all, about 90% of retail today is done still in a bricks and mortar environment, 10% done online. That's going to switch. There's still going to be bricks and mortar retail places, but that 10% number is going to go up by multiples. I don't know if it ends at 30% or 60% or even 75 or 80%, but that's an industry that you can get in now, and it's going to take years and years before that kind of levels out and the scales start to balance out. The other one, which kind of goes hand in hand with that, is mobility. So it's not just online purchases, it's mobile online purchases. So I would say you would be doing no wrong at all if you went into online retail or anything mobile, because that's essentially the entire tech industry, I think, if you had to sum it up. And that's what we look at all day, right? So we're not what you call thematic investors, that we sit around figuring out that everything's going mobile and online. It just is. We don't want to be kind of mavericks. But we have people come in and pitch us and tell us what they've figured out after hopefully 10 or 20 years of experience, and then we essentially validate what they're telling us. And I'm just reporting that most of the people who come in tell us about mobile and e-commerce. And for those of you in the room, I'm sure you can probably validate what I'm saying, or when we open it up for Q&A, you can tell me I'm all wrong.
So speaking of mobile and e-commerce, this is mostly for the 2 early stage guys here. So I took a bunch of students over to Israel, and we studied startups. And we did, for 2 weeks, the students, this was this last summer, over the course of 2 weeks, their job was to come up with a company. And it actually, they took it very seriously, and there were some really good ideas. But pretty much every company was an app. And so my question to you early stage guys is, one of the criticisms that I would hear when I was pitching, luckily both of my companies are still going and they're profitable, et cetera. So, but I would hear the criticism that, well, we're not sure if your company is a product or an actual company. So when you guys, what are your thoughts on apps? Because I think if we ask most of these guys here, do you have an idea for a company? The first thing that comes to their mind is an app. So just give some
Sure.
reactions to that.
Sure. So, well, I look at an app as a delivery mechanism, right? So you have an underlying business problem that you're trying to solve, and there's hopefully many millions or billions of dollars at the end of that rainbow if you solve it. Where people tend to criticize apps is not because of apps as a delivery mechanism, but apps as a proxy for the size of the problem you solve. So if you help me find my keys to my car when I can't find them, I don't care what the delivery mechanism is, that's not really that valuable a problem. So you're probably not going to be that big a company in terms of revenue or that big a success in terms of the capital you generate for your investors. So whether it's, you know, online versus on your PC versus your phone via the App Store, I'm not really concerned about that. You know, but I want you to be solving a very large, valuable, you know, heretofore unsolved problem. And the reality is you'll probably deliver that via the PC, the mobile phone, and an app, but it's merely a delivery mechanism as far as I'm concerned.
Yeah, I think you know what we see in the market is similar to you know what you saw during that class. You know, last year I think they counted probably close to 50. I think it was the exact figure was $48 billion in venture investments. Roughly 40% or maybe a little more than that was in various apps. So I think one, people tend to like to build apps because that's kind of the lowest hurdle. You know, it's easiest to tackle, and it kind of goes to Tom's point earlier. So is your product or your idea, your app, is that a feature or an actual company? Are you building a business?
Let me ask you this. Anyone know how much it costs to use the LSAT study guide app? It's one of the most expensive apps there is online. It's hundreds, if not thousands of dollars. And, you know, it's a great business. So, you know, that compared to a website that makes no money, I'm going with the LSAT prep app because we might sell it to Princeton for millions of dollars and make tons of money. So you might hear, yeah, apps are, you know, who wants an app? Well, I want an app if it has millions of dollars in revenue and solves a real keen business problem.
Exactly, and I think you know I echo the earlier point is that you have to look at the underlying side of the opportunity, right? OpenTable is an app. OpenTable was sold for billions of dollars, right? And you also have, I don't know how many of you guys watch Silicon Valley. There was a one earlier, I think third episode or something. There was a guy.
I think Tom was a guest performer, I believe, in season 3.
There was this scene where the guy goes into the Bevmo store, and the store clerk was telling him about his business idea. He's like, oh, I built this app for parking, right? You just write down where you parked, or you use this NFC technology or whatever. And the guy asked, why don't I just use a pen and a paper? Well, but this is mobile. This is an app, right? So it's a stark contrast. I mean, a little exaggerated, but it's a stark contrast between the underlying size of the opportunity, right? OpenTable, huge opportunity. Yelp, huge opportunity. Parking app, not so much. Right.
So we have an entire entrepreneurship class here. Professor Bellows brought his class. Thank you, Bill. What advice would you have to the entrepreneurs in the class, in this room, not just in Bill's class? There are a lot of other entrepreneurs here, but you know, maybe I don't want to emphasize the negative necessarily, but you know, mistakes you've seen. You know, hey guys, don't do this, or maybe do that. But you can emphasize the positive or the negative in your answer, however you want to answer. But then also, I know when I was an entrepreneur, I had mixed advice. Some people would to us the holy grail was we got to get a meeting with you guys, and we got to get money from a venture capitalist or an angel investor. Niels was way out of my league, but that is not, you know, truth be told, you guys can be honest about this. I'm sure that's why we got you on the panel here. You know, it's not necessarily the holy grail to get money from you guys, right? So maybe you could touch on that as well. I don't know. Go ahead.
No, I can actually. So find a mentor, right? And if you can, a deep capitalized mentor. That's always a good thing. When you start a new business, because I started a new business in 2005, 10 years ago, so I had a deep-pocketed partner. We had a lot of capital from existing clients. Not as we had, you know, $250 million, right? It's a lot different than $6.5 billion. But we always tried to keep our revenues ahead of our expenses, right? You can't do everything you want to do day one. And you've got to, someone, you can have a creative genius like Alan and Randy or something and Tom, but you got to have somebody who's paying attention. And that's important. So you need to understand that if you're going to be successful, you've got to have different components. And you're never going to do it on your own. Never, ever. The smartest people in the world fail. They have to have a team. And the smart entrepreneurs really get that and know that, and they know their weaknesses, and they find someone to plug that hole. So that's my little advice, being an entrepreneur myself, and build it as fast as you can, but it has to be within the reasonableness of your of your revenues.
I think finding a mentor is incredibly critical. I feel like I'm repeating what you said. Before Mark Benioff was Mark Benioff, he had Larry Ellison, right? And then the same guy that founded Zenefits, he had Mark Benioff as his mentor. So you see this kind of chain of mentors creating great entrepreneurs. And I think second point is to be humble, to really be open to talk to a ton of folks, right? Whether it's a VC, whether it's a late stage investor, whatever it is, somebody will know something that you don't. And increasingly, especially with VC and entrepreneurship, heating up and a lot more people paying attention to it now, there's this, sense of almost arrogance within the Silicon Valley community that you, as a VC, I know I sound totally bitter, within, if you go to Silicon Valley and you try to talk to whoever, a new startup, especially if it's a hot startup, you can't get a meeting. They won't take a meeting with you, right? So, and I don't want to call names. There was a company that did online clothing. Let's just call it Zanobos. I don't want to name names here. 2 years ago, that was a hot company, right? Couldn't get a meeting with that guy, and look what happened 2 years later. The guy was calling everybody he knows on his Rolodex trying to raise money. Couldn't. Guess what? He wasn't listening to anybody. He wasn't willing to sit down with anyone, right? So it kind of comes back to you.
Sure. So there are definitely multiple kinds of entrepreneurs, and I'm not suggesting you kind of take the safe route, but one of the safest routes would be spend 10 years in a particular business, moving up the ladder, getting trained at the expense of some fairly big company, and then when you've got a little bit of maturity and gray hair and a ton of expertise in a particular industry, you quit that job, you bring 5 people with you, and you know in your heart and from your experience that you're solving a particular problem that big company has failed to solve because they don't think it's big enough, right? And so those are the kind of people I get most excited about as an investor. And so, again, I'm trying to make your life a little bit easier. If you're that guy who's just too restless and you're like Mark Zuckerberg and you're going to quit your freshman year and make $1 billion, then that's fine. Go ahead and do it. But the slightly safer way to do it is to wait till you're that guy who goes to your boss and says, I don't understand. Why aren't we online? Everyone's going online. Your boss says, well, we can't go online because the online product would have 1/10 of the cost as our primary product, and we just cannibalize all our revenue, and we don't want to do that. Okay, when you hear that, and you've got 10 years of experience in the business, you quit, you take 5 guys with you, you come pitch that to me, and I go, great, let's do it. Let's kick the ass of SAP and Oracle and Microsoft and whatever it is. That's the slightly safer way to do it because you've got more confidence, you've actually got more experience, and someone like me actually gets way more excited about the idea.
Yeah, I can't agree more with what Randy's saying. Not that I'm in the VC world, but the bottom line, if I'm a young person, I would, unless you're the incredible exception, I would go to a company where you learn how to do things right. Because it's amazing to me how many people, like if you work at an accounting firm, a consulting firm, a law firm, a boring firm, right? But you're taught to do things the right way. And so you can turn that on your whole life. You know that you're going to stay up till midnight, 2 a.m., whatever it takes to get it right, to get your product out when you're the entrepreneur. Because that's how it's done, and that's the expectation on the other side. You can also just turn that skill on, having worked in that environment. Maybe you don't have to do 10 years, but if you've been in that environment, you can go into any meeting with anybody, and most investors are older than you no matter what, right? You're going to be able to fit the role of what they want you to be to get their capital, and that's the name of the game if you want to be an entrepreneur.
So only one more or 2 more questions from me, and then we'll open it up. But I noticed you guys avoided my question. So raising money. So it starts with friends and family. Uncle Charlie, please give me $5,000. Give me $25,000. Then you go to Randy. You get 100, 250, whatever. Then you go to Alan. You get 3 million, whatever. Then you have EBITDA of 50 million. Then you go to Neil. But give some advice to the audience here on the do's and don'ts of raising money, and kind of like my question was last time, is it always the final step to come to you, or hey, maybe just have profit and maybe that is the best route and never go to you? Though I'm not saying that's the right answer. I'm just throwing that out there to let these guys think. Go ahead.
Sure, I'll address this one a little bit. I'm a little biased. I think we're all biased up here, being in the roles that we are. I would say, you're trying to build as big a team as you can. You want mentors, you want board people, you want advisors, you want a whole staff of people. You're hopefully managing 100 people someday. And the quicker you can do that with the highest quality people, the better off I think you're going to be. And that includes your investors. So I think, again, opinion of one, I think you should take outside money. I think you should take it from smart people who are experienced at helping companies do what you want to do, and I think that'll increase your chance of success. In terms of mistakes throughout that process, the biggest one I see is, maybe what I'll call naivete, coming in and just essentially telling me it's not going to be that hard, either because you don't think it's that hard, which would be the worst scenario, or you think that's what I want to hear, that it's not that hard. I no way believe it's going to be easy. So like I said, you either are lying to me or you think it's going to be easy. Both are terrible scenarios. So come in, tell me how hard you know it is, and what great answers you have to overcome the challenges that you're going to face, that you're going to face, and then we can have kind of an adult discussion about how I can help you with financing.
I would agree with Tom's point on, getting money from an institutional VC is not the holy grail. If you really look at the stats, so 80, 90% of the startups don't ever raise institutional money, ever. And especially with the emergence of Kickstarters of the world, some of the recent successful examples are Canary. Do you know what those are? The home monitor, security monitor? And that company is valued over $1 billion. It only raised money on Kickstarter. Another example, Oculus, right? The company that sold to Facebook for $1 billion or some crazy number. That company never raised institutional money.
Which I passed on.
Do you cry yourself to sleep every night now? Anyhow, so getting VC money is not the stamp of validation that you absolutely need to succeed. It's not. And second, I would say a huge thing that as a potential founder, you need to watch out for is the obsession with valuation. Now, everybody talks about unicorns. Now we have this thing called decacorns, right? If you valued above 10 billion. But if you really look under the hood, a lot of these term sheets or valuation structures, they carry a lot of weird terms. A lot of founders are giving up these structures in exchange for a high valuation. What I mean by that is, I will give you, say, a $500 million valuation, but you have to guarantee my 3x return on my investment, right? So that's the stuff that you don't read about in the newspaper on TechCrunch, right? So as a founder, you really have to watch out for how much dilution am I taking? Am I raising $100 million at a $300 million valuation, or should I raise a smaller round at a a slightly lower valuation and take less dilution and really control my burn, right? And secondly, watch out for those structures that might come and bite you in the butt.
Yeah, my only advice on raising money, it's kind of like a job, is to be incredibly persistent. I mean, if you were raised in a kind of a normal kind of run-of-the-mill house, you were taught to be polite all the time, and that's nice. But if you're looking for a job or you're looking for money, you have to be polite, but you've got to be persistent. And sometimes, like before we hire anybody, just for an example, we never hire anyone on the spot. I mean, it takes months and months because it's a process. We want to see how you react. We want to see if you go find somebody who might know one of us or something and reach out. and get a you know it's so you can the process tells you a lot about people. So the same with money. Now it's a little bit different if it's the greatest idea and they can these guys can recognize it and they better hit it, no matter what valuation or percentage they get. But in most cases it's the same dynamic, which is be polite, come in, if you can get someone to introduce you, but come back and show progress. And absolutely say where you've made a mistake. Like if everyone's made a mistake, right? Experience is a series of making many mistakes, right? So you have to point that out to show that you understand. To Randy's point, that you have to work through issues. It's going to be hard no matter what business you're in. There's very few instant successes. So I think don't be annoying, but persistent. There's a difference. But I think that's important. And going back to an earlier thing, 'cause I just want to make sure I get it out there. When people, we don't have a big internship program. We don't have a formal internship program. We don't hire people out of interns because we don't need people who are right out of college. Sorry. But if you work at a firm like ours, we do have college kids that work, it's amazing to me how people don't take that great opportunity to go ask questions, right? Smart people who are running businesses want young people to come up. They don't want them to do it at 9 a.m. as they're sitting in their, getting their coffee out in their donut, but they do want you to come in and ask good questions. And they want you to come in with a well thought out question, right? Something that might solve a problem. And it's amazing to me how some kids get it and some kids don't. And it's so apparent to management, I'm just telling you. So it's such an easy way to impress wherever you're interning or wherever you're first starting out in your job. Ask questions, but ask good ones and ask them at the right time. But be persistent, and those are my advice on that front.
Excellent. Okay. Before we open it up for questions, I am going to do a plug for what Tommy White, Professor White, is putting together. So it's called the Venture Capital Investment Competition. So a lot of you have been in case competitions before where you are the entrepreneur. In this case, you are actually the investor. And so real companies will come and pitch you, and you create your own team. And so it's going to be, AU is going to create a team that's going to go out there and compete against Notre Dame and Boston University and BC, and Harvard's in it, Columbia, a lot of, I think, 48 schools across the country. So this is going to be a competition where AU can go out there and show other schools what we can do here. So Professor White is the guy, and so if this is of interest to you, and you're actually going to put a term sheet together, and guys like these guys will be sitting there evaluating the questions you ask and what sort of term sheet you put together. So it's called the VCIC. So talk to Professor White about that. And then also, Veronica, where's Veronica? Veronica's right here. Tonight there's a networking happy hour for the Masters in Sustainability Management Group. And talk to Veronica if you're interested in that. It's downtown. The question I didn't ask, and I'm not going to ask it, we're going to go to questions. I was going to ask you guys about sort of the West Coast offense versus the East Coast offense. Alan, when I found out Alan was from San Francisco, born and bred, went to Berkeley, I was like, so when are you heading back there, Alan? And, so a lot of these folks here are wondering, should I start this company on the East Coast, or should I go back? Do I have to be in Silicon Valley?
Do you want to dress like me or like Alan? I mean, that's the question.
So, Alan, so I threw it out there. So if you could just spend maybe 30 seconds on that, just Alan.
I don't think it really matters. As long as you're a good company with a good product, with a good team, you will be discovered by a good VC. So whether it's New York, Boston, in the Silicon Alley or San Francisco. And you're starting to see a reverse trend. People are moving out of San Francisco because of the crazy housing prices, because how expensive it is to hire good engineers. So it doesn't really matter.
Austin, Texas.
All right, so who has a question? We'll give Professor Bellows first dibs, somebody from your class, Bill.
Speaking of that,
So we can get it on the
of course, it doesn't matter where you are. My question will be: do you have any experience with like international markets, or just U.S. markets? Like,
Sure. we actually do look at international opportunities. We're actually about to announce a huge, actually our biggest investment to date into a sports data company based in Switzerland. So we're open to all kinds of ideas. Right now for us, the low-hanging fruits are in Europe. Possibly next one will be Asia for us, and we've looked at deals in Canada, in Australia. So, going back to my answer earlier, it doesn't really matter as long as you're a good company.
Yeah, we do deals out of our UK office, and it's the same dynamic. Banks there, again, on the precipice of disaster, bailed out by their respective companies. They're being turned into utilities, so there's a lot of lending opportunities in Europe. So we've set up a number of companies out of our London office.
We're just focused on opportunities in the United States.
Hi. Well, thank you for coming, first of all. Second, my question is, what do you guys look for if, for example, I wanted to work with you guys, or if anybody else wanted to work with you guys to join your team and invest with you guys? What are you looking for? What's the experience? I don't know if any of you went through that process, or you just haven't had the capital at the time, or, yeah, just give us a little bit of that.
So I'll start off. First of all, you've got to rise. You've got to outshine yourself from the pack, right? So people that come in and kind of figure, oh, I just got out of college, I don't have that much experience, Randy shouldn't expect that much of me. That's not going to cut it. You have to come in and say, I've already been a summer intern twice at a venture firm, or I worked on Wall Street, or I did something that shows I have an interest in this industry and I can get things done. So those are the people that we're only interested in talking to. Everyone else is, barely getting a return phone call. And then the people that have gone above and beyond and, ran their investment club in college, already interned somewhere, maybe they started a small business in high school or college, those are the people we'll talk to, and then we'll decide, from that kind of a group who might have the best fit for our personalities and our companies. But don't think that we really, again, I'm just going to speak for myself, I don't value your college education all that much. I want to know what else you did to prove you want to work in my industry.
But you do care how you do in Tom's class, right? That's right.
I do want to get invited back, Tom, but yeah.
Bring the transcript.
No, but seriously, I'll talk to your professor and say, who do you recommend? Who's been the most standout, not on the tests, but in terms of the questions and the out-of-class stuff and who comes to office hours. That's what I want to know, because just because you got, the highest score in the class on the test doesn't really tell me anything about how you're going to interact in my company.
So after I graduated from Cal, I was kind of deciding between consulting and investment banking. Ultimately, chose investment banking, and I think post iBanking, a lot of people either going to venture capital, or they call it the buy side venture capital, or PE. And if you're interested in venture capital, there's a second route. You can be an engineer or be some kind of technically focused expert in some area. So I think PE, you kind of have to go through the traditional banking. You got to work for Morgan Stanley, JPM, Goldman Sachs. But for venture capital, I think there are different routes you can take.
I mean, for our business, we really need people who are experts in certain areas. So we tend to be full of folks that have either, whether it be a law degree, an accounting degree, MBA, CFA. So we need people who are, been 5 to 10 years out. So that's kind of what we look for, which I know isn't great news for this crew. But my recommendation would be to go work for a firm like an FBR, which is an investment bank, pretty much the only sizable one here in town. It's a great place to go work for 2 to 5 years. And then from there, you make the connections and you learn the basic, building blocks as, we just talked about it on banking, what Alan did. I mean, that iBanking is a great place to start if you want to be at a firm like ours. You get basic grounding, but you have to have a college degree. I would agree with Randy on some level. It doesn't matter, but it helps eliminate things that you don't want to do, guide you to where you might want to go, and then on your grad school be more focused there. And that's so college is hugely valuable. It's great that they teach entrepreneurial things in undergrad. They didn't where I went to school, and I think it is. I think it's a great discipline, but make sure you're winnowing out things you don't want to do, and then go to grad school. After you've worked a couple years. I mean, that's the perfect path if you want to be in business and you want to be we're all on the buy side. We're all people who don't sell things. We're people who invest in things, right? And so. That's how I would describe the business. And the buy side is where everyone wants to end up. I mean, they'll lie to you and say they don't, but they do, right? They want to be on our side investing because it's the most fun, it's the most creative, and you're really making a difference. I don't want to get overly dramatic because that's ridiculous, but you're not at the hospital, but you are making a difference. And so those are the areas that I think are the best. The sell side is a good learning place. That's how I would put it. And the big challenge I see for young people call all the time, I'm on the sell side, how do I get on the buy side? That's the big Rubicon that you got to figure out a way to cross. But you do it by connecting with people, by impressing people. I have a guy who used to work for me at FBR, and the guy, I know every quarter on like Tuesday, he calls me and he asks for lunch. Now I blow him off half the time, but I do go to lunch with him regularly. He's impressed the crap out of me. He started a company recently, and I personally gave him money because the guy, I know he's going to deliver because he's consistent with me. He has a business plan. He's surrounded himself with good people. He got angel investors here in town. That guy knows what he's doing. I mean, he's going to be successful. I won't tell you his name, but I know he'll be successful and give money and be this guy's name, Kogod School of Business. I mean, he's just that kind of guy. But it's that discipline and it's that persistence. And it's understanding that he can't do it alone. Those are the things that I think are, and he's able to raise money from people. If you get one person to give you money, you want that person to then say, hey, can you introduce me to other folks that you like investing with? Randy, who do you respect in town that can also give me some money, or at least give me a chance? Because if you can endorse this, then that's how you go about it. But it takes a lot of groundwork, takes some time. It can't be done in year one. It takes 5 to 10 years.
They come here every Tuesday night to get their MBA, professional MBAs. And we're going to throw the mic over to a Marine, actually. Dan, go ahead.
Thank you for that introduction, Tom. My name is Daniel Feeman. I just want to thank you guys for being here real quick. My question is particularly in regards to seed, angel, and VC. Do you guys see any connections, particularly with studios, startup studios and startup foundries? Are you forming any of those relationships, trying to move a little bit more towards the app section, but move a little more towards a group with shared foundation that builds something consistently and repeatably?
Yeah, sure. We have a lot of relationships with incubators, but this goes back to the comment I made earlier about not being thematic. We essentially want the best companies to rise to the top and come to us and explain to us and prove to us why they're different than the fray. So instead of trying to sort through 100 companies at an incubator or a foundry, I want essentially you to do all that work before you come to me. And it's somewhat distracting to get that deep in the weeds and see you at that rudimentary a level. Now, if my competitors were stealing all my deals and that turned out to be a fantastic way to get those deals, I might change my philosophy on it. But essentially, I want you to, go through all that work yourself and then come to me and say, look what I've done now that I'm, in adolescence from a corporate standpoint.
I would say working with incubators is actually, at least in my world, looked at very positively. If you go through a YC program, what we're trying to do is actually talk to these YC guys, advisors, or whoever they are, and use them as a deal funnel. Because I can only make so many calls every day and go to so many cities in a given week before my girlfriend gets really mad because I'm always on the road. Talking to these incubator guys, the YCs, the 500 startups of the world, serves as a great deal funnel. The thing is, their approach, inherently just brings a ton. It's a numbers game for them, right? It's kind of like, I call it the spray and pray method. So you do have to kiss a lot of frogs as you talk to these guys, but I think there is inherent value in just networking with YC, and as you as a potential founder going through that program, one gives you $150,000 off the top, and two, you get great mentorship. You know, there are some really, really smart guys at YC.
Hi, my name is Jacob Huang. I'm a junior here at Kogod. So my question is for Alan specifically. With companies like Uber, Lyft, and Airbnb, for the past 5 to 10 years, the idea of sharing economy has been getting a lot bigger. What are your predictions on the industries that it'll upheave next? And also, what are the benefits going into banking for VC rather than being an entrepreneur?
Okay, I'll answer the first question. Actually, we were the very first investor in the first car sharing business, Zipcar, which we sold to Avis for $500 million. You know, I think we always talk about how we kind of sold Zipcar short. You know, it was too early for its time. But I think the next industries, really, multiple industries, I think on the verge of being disrupted, if you will, are one, fintech. You're seeing sort of the first wave of lending club on deck of the world that are, you know, transforming the consumer lending space. Next one will be healthcare. You see Oscar getting funded at $1 billion valuation. So for me, I'm trying to understand what they do still, but I think that's an area where we're going to see a lot of movement. And thirdly, it's the drone space, right? Not necessarily in the consumer drone space, because you know how often are you going to go out and spend $500 on a Lilycam, right? But it's really in the industrial application side, on the industrial application side. So those are a few areas I think we're going to see a lot of activities. And two, I think you asked me something about investment banking.
Yeah. So like, what are the benefits going to banking for VC rather than being like an entrepreneur? You know?
Well, I don't think there. I mean, there are pros and cons for both sides, right? I think if anything, being, you know, having that entrepreneurial background, having started a company, you know, probably positions you even better for some of these VC firms. You see a lot of, you know, like Kleiner Perkins hired some guy who ran it was like an early stage startup to be their like head of early stage investment, right? So. And for me, I kind of took the safer route, you know, going through investment banking and interviewing for all these different VC firms, right? That was kind of the most direct route. But to be an entrepreneur, to start your own company, I think it actually gives you more credit as a potential VC.
Capital. I mean, if you have capital, be an entrepreneur. If you don't have capital, go to investment banking.
I was just wondering, what was one book that you've read in your life that has most influenced your personal and professional career?
Randy, that's yours.
Sure. The Risks and Characteristics of Standardized Options. That's a good one. It goes back to one of the points that we made earlier. Just, you know, learn something, maybe it's multiple things, really well. You know, and financial products is one thing that you can learn. There's not a lot of BS there, you know, when you look at the world. I mean, every day when someone asks you to make a decision, it's essentially a math problem. You know, how long is it going to take me to get to this meeting? You know, am I better off taking this road or this other road? Should I do this today or tomorrow? I mean, it's a probability and statistics question. And so I would suggest you get real schooled on probability and statistics, and stock options is one of the best ways to do that.
It's hard to pinpoint one book that's been most transformative, but I can recommend a few if you're looking to get into the VC world. One is called Term Sheet, written by, I think it was Fred Wilson. It's a great introduction into like what the deal terms will look like on a typical term sheet. What are the things you should care about as you think about taking VC money. Another really good one is called Hard Things About Hard Things, written by Ben Horowitz. I'm actually getting through it now. So far it's been incredible, just seeing how he has progressed, going from an early entrepreneur to one of the best VCs in history.
I went to college with Ben Horowitz. Unfortunately, I was not friends with Ben Horowitz, so that was unfortunate, but he's my age. So the only thing I have over him is more hair. That's about it. But no, I think picking one book's probably a tough one. I'm a history guy, and I honestly think that you learn, and my partner is too. He's and we know economics, we know the art of the deal, all that good stuff, but it's really, I think, you really have to be a good student of history. I honestly believe that, and I really think that, you know, I think I'm a big World War I buff, and the world changed then, right? And it's those tumultuous times that are going to create all the great opportunities where people make a lot of money. And whether it be 2008 meltdown, the people who've been in D.C. a long time, 91 was really 90, 91, the real estate break here. The richest people in D.C. are real estate people who made a killing in 90, 91. The richest people I know in New York are not on Wall Street. They're real estate people. When the lights went out in New York, Abe Beame was mayor, and they literally had a blackout, right? And this was in the 70s. Those are people who gobbled up. They borrowed, they stole, they got whatever they could to buy real estate because they realized this was the chance of a lifetime, right? And so you guys have all lived in the kind of the internet world, right? But there was a pre-internet world. I mean, there was a period where and so I think if you understand historical inflection points, we understood it very clearly. Thankfully, in 2008, it really could have, the system could have gone under, but we knew that history was going to tell us it wasn't going to go under, right? That the people in charge, Bernanke, understood the Great Depression. He wasn't going to let it happen, right? He was going to do whatever he could not to let it happen. And so so maybe that's sappy, but I do think if you understand where inflection points happen and you can understand how to exploit it, those are the people who make the most money, in my opinion.
I'm Lakshmi. I'm in second-year MBA program here. Thanks so much for coming today and sharing your deep insights with us. Since we discussed something on the apps, I have this question, all these big technology giants are paying fat prices for buying apps, basically. Facebook paid like 18 to 22 billions to buy WhatsApp. And then there is a lot happening, buying the startups and all. So do you think there is a bubble kind of thing happening in the technology industry right now, which is eventually going to burst at some point?
So this is an easy question. So going back to what Neil said about history, history always repeats itself, and past performance is completely indicative of future performance. So there is a bubble going on right now, which means people are overpaying for future expectations. Whether it bursts or not, history says it'll burst, but it may just fizzle out. But history says there'll be some kind of dislocation. And, to the extent you can take advantage of it, we don't know exactly how long it's going to last. The stock market went 80-plus months without a correction, which was the third longest time. And what do you know? There was a correction in August. So, history will repeat itself, and it would be very statistically unlikely that the valuations you're seeing for these unicorn-type companies hold up over time.
I'll just pile on here. I think we're. I don't know if I want to call it a bubble, but we are seeing really lofty valuations on a lot of these companies. I used SaaS as an example earlier. The valuation has come down. So, in that sense, the market has been somewhat self-corrective in the last, call it 24 months. However, I think a lot of the lofty valuation was driven by new money coming into the VC world, PE guys, hedge fund guys, coming in. You have the Fidelities of the world funding Snapchat at $1 gajillion valuation, right? So I think because people are seeing this opportunity to make outsized returns in the VC world, so a lot more money the institutional money that's traditionally targeted at other type of assets are coming into this asset category that's driving up the valuation. And at the end of the day, like I said earlier, good markets come and go. Good company will stay. So that's really on you as a potential VC or as a potential entrepreneur to find a good company, to build a good company that will stay.
All right, so want to let you guys get out on time. We got through this without saying the word unicorn more than 3 times. That was awesome. But if you all would like, I know these guys will stay for a few minutes if you want to meet them and ask more questions. And let's have a big round of applause for these guys.